Hello everyone, welcome to the DIY Investor Workshop Webcast. In this first part on goal-based investing, I would like to start with uh, the basics of cash flow. Now, imagine this blue line to be the income that you get. This could be your salary, your business income, your rental income, your dividends, etc. Now, this is from today to into the future. Now, from this cash flow, you will be taking out money for your monthly expenses. You'll be taking out money for your home loans or personal loans or any debts, unexpected expenses that may come, emergencies, and so on. And then you need to use this money to save for your short-term goals that are in the next year, next 2 years, paying yearly school fees, paying car insurance, and so things like that. And you also need to use this money for investing for long-term goals. That is goals like retirement, your child's education, and so on. That's far out in the future. Now, at some point, this cash flow will stop. That's when you retire. Basically, your active income that you got from your job, from your business will stop. And then you need to generate a passive income from a corpus, which is your retirement nest egg. So that's the green arrow. That's your income in retirement. That could be your pension. That could be income from your investments that you've done so far. You're taking out money from them and so on. So even in retirement, there will still be outflows like monthly expenses, unexpected expenses, and so on. And this is the basic scheme of money inflow and outflow in a person's life. And we need to plan such that these requirements are met. That's the basic idea behind goal-based investing. Now, we will be talking about the benchmarks for money management, for personal finance. And I can think of three benchmarks, although you can argue that they are related to each other and not independent. There are three benchmarks I can think of. One is insurance, the second one is inflation, and the third is peace of mind. So let's look at each of these benchmarks now. So let's start with insurance. Now, there are different approaches to personal finance, and the most common approach that you can see amongst your friends and colleagues, relatives, is that people think about tax saving first. They don't worry about their needs. They don't even worry about whether the product will be really suitable for them. They just worry about tax saving first. And then there are people like who want products, want packaged products. They want, if they're looking, if they suddenly realize that they need to plan for retirement, they will say, I want a pension plan. They suddenly realize that they have children, they'll say, I want a child education plan. And then there are others who think about only returns. There's a mad hunt to get more and more returns with or without risk. That's a different matter. Now, instead of that, why not we think about our needs first? We ask ourselves, what is it that we really need? And then we choose products. Needs first, products last. In such a strategy, tax planning will become incidental. Tax planning will be incorporated in our search for finding products which will satisfy our needs. Such an approach is called goal-based investing. So let's start with insurance, and that's with that basic background. We'll start with what insurance is. Now imagine this nested doll to represent your family and your financial health. The family is in the center. That's the most important part of your life, and you need to protect their financial well-being, their happiness, with several layers of modes or layers of protection, if you want to call it. The first such layer is term life insurance. If you are earning a salary and if there are people dependent on you, then you need to worry about what will happen if you were to die, your income stops, and how will your family manage their future needs and their current expenses. So you need to buy a product known as pure term life insurance. This will not give you back anything. It will not give you what is that, cash back. This is not an endowment scheme. This will not give you money back after 10 years, 20 years, and so on. This is just a product that will pay a lump sum to your nominee in the event of your death. Many people are in a hurry to decide their term insurance sum, how much the sum that the nominee will get. They just think that 1 crore is enough. They just go for it. Well, it's not terribly wrong, but the point is that the money that you get yourself insured for should be enough to generate inflation proof income to manage your monthly expenses, at least until your kids go to job. You need that money should be used to pay school fees, college fees, manage expenses, other liabilities that you may have, and so on. I have a calculator for this where you can do this, where you can calculate the exact life insurance required. Of course, it may be on the higher side, so you may choose to buy a little less, especially if the premium is high and so on. Now, many people are worried about what policy to choose. Now, the insurance regulator IRDA has made it extremely user friendly. They have mandated that the insurer cannot deny a claim which is 3 years old. They cannot say that there's a problem in the application, that the nominee has withheld information, and so on. If the policy is 3 years old, then claim settlement ratio does not matter. You can choose any policy and hope you will live for at least 3 years, and then you are not worried about whether they will settle or not. They will have to settle. Those are the new rules. Now, so don't worry about it. Get yourself one without thinking too far. Just buy whatever you're comfortable with and whatever you can afford, and that's about it. The cheapest should do, but don't buy term insurance for 60 until 65, 70ish. There's no need to do it. If you're in your 30s, then you need, I think it's maximum to age 60. You need insurance until 60 or even 55. That's good enough. You should be able to invest regularly, increase your net worth so that your net worth exceeds your term life insurance sum as soon as possible. So don't get it for an extended period because it will become expensive, especially if you have some kind of medical conditions and so on. Please be honest while applying. Declare everything that needs to be declared. That's all there is to it. So that's the first layer of protection. The second layer is emergency insurance or emergency fund, if you want to call it that. Everybody gets unexpected expenses, good expenses, bad expenses. So you need a rainy day fund. How much this fund should be? Well, it's very difficult to put a number to it. At least 6 months of monthly expenses, preferably 12. This money should be can be used in so many ways. You may need to, if you have liabilities, then it's better to have some kind of extra sum to take care of that liability as well. For example, if you're running a home loan EMI, it's better to have a separate emergency fund just for that home loan EMI, which is about 1 or 2 months of home loan EMI, or maybe 3, so that in case you're laid off, in between jobs, you can continue to pay the home loan EMI from that fund without affecting any of your other expenses. It's not easy to get this sum. I would recommend that you put away 5 to 10% of your salary towards this emergency fund, whether you think you have enough or not. Whatever happens, just put away 5 or 10% to this emergency fund. The reason I say that is because if there is an emergency, you will be taking money out of this fund, so that sum will decrease. So you need to have some kind of inflow. You should be able to replenish this emergency fund. Therefore, that 5 to 10% inflow, I think, from your salary at all times is would be prudent. And please remember that even if you have a cashless claim, if you are hospitalized, if your family members are hospitalized and you go for a cashless claim, you still need to pay for what is known as non-medical expenses, and that will be about 10 to 15% of your medical bill. So you need, so this money will be used in ways that you can not even envisage. So please be prepared for the worst when you put this together. Where do you put this? Uh, I think a good amount should be kept in a separate SB account. Do not use your salary account, because that's the one you will be using for everyday expenses, investing, and so on. Suggest you do not use your salary account. Put it in an SB account, which you typically not touch, but ensure you keep it alive so that it doesn't become a dormant account. It won't remain dormant if you have emergencies, but I'm just saying. So online FDs are a good way to do it. There are, of course, sweep FDs where you can remove money to the extent that you want, and the remaining will still be in the FD. Sweep in FDs are possible. Liquid funds, if you want to, for example, the any liquid fund is not really liquid. It could take up to 2 days depending on when you withdraw. Uh, a credit card for an emergency is okay, but don't use a credit card if you don't have the ability to pay back in full. A credit card is a good idea in these days because sometimes you need that. You need, otherwise other modes of transaction are not possible. For example, if there's an emergency hospitalization, or an emergency purchase that has to be done, so a credit card helps. But you must have the ability to pay it back in full before the due date. Otherwise, don't do it. Coming back to liquid funds, uh, put money that you, for example, the EMI that I said, or maybe some amount which may be used for emergency hospitalizations. That amount, a portion of your emergency fund, can be put in liquid funds. But ensure that you have instant liquidity by having some money in SB accounts or online FDs. That's crucial. Well, the Chennai floods have taught us that some amount of money at home is also important, but there's a limit to this. At any point in time, maybe about 5,000 or up to 5,000 should be okay. It should be able to manage. It's not an everyday event. So, okay. So that's the second layer. Third layer is health insurance. Everybody typically has a health cover from the employee, but this is not enough. I would suggest that you go in for an individual health cover. If you cannot, I would recommend that you go for like I said, an individual health cover, meaning that you get a separate medical line, but you also get one where the each member in your family is covered separately. Each one has their own separate policy, instead of a floater policy where you have um, a sum which will be used for any member. Uh, you have a you. I suggest you go in for an individual cover. Of course, this could be expensive. So if you want, you can go in for a floater initially, and then maybe go for a super top up and so on later on. There are so many aspects to this. During the investor workshops, when I get to this slide, there'll be about half an hour discussion on just this alone. So there's a lot on this alone. So I don't want to dwell too much on it, but just to say that um, if you have senior citizens in your dependent circle, parents, in-laws, do not include them in the floater plan. Get a separate plan for them and get a floater plan for the rest of the family, because their risk profile is different from that of the rest of the family. So their premium will be higher, and they will determine the premium of the entire floater plan. So and also they may get hospitalized more often. It's better, and so that you get them an individual cover. If you put them in the floater cover, and if they use up all the insurance sum, then when the other members get hospitalized, it may be a problem. So please recognize that although the insurance regulator has said that your claim history will not affect future premiums, um, the premium can increase for a wide number of reasons. You may just you may go from one age group to another age group in their risk profile calculation, or basically too many people may be getting sick and the insurer will say, I want to hike up premiums. A lot of things can happen. From from our experience talking about insurance at Asan Ideas of Wealth, people in South India typically they have a much lower hospitalization cost than those in the north including Bombay. From Bombay upwards, I would say. So maybe if I would suggest you go to your neighboring hospitals, find out the room rent there. What is the room kind of room that you will take, and what is the rent for that? And if that is pretty high, then you go in for a policy which does not have any kind of sublimits. That is the typical policy from the PSU insurers, United India, New India, and Oriental Insurance. They have a sublimit of 2% on the room rent. The room rent cannot be more than 2% of the entire sum insured. So if that kind of limitation is not suitable for the room rents charged in your neighboring hospitals, then I suggest you go in for a plan without sublimits. Please note that it will be expensive. But if you have a reasonably solid job and you have a good employer cover, I suggest you go in for a PSU cover with a room sublimit clause. It's not a problem. Just increase the sum insured each year so that you will be able to it will cross over the limits in your neighboring hospitals. Of course, inflation, medical inflation is there and so on. But that's something you need to take a call, informed call on. So people in South India, I would say, I think they could get away with um, policies with sublimits. South India, excluding Bangalore. Bangalore is a crazy city in terms of expense, I think. Other guys, I think they may need, especially people from big cities. I think they need a policy which is which does not have any sublimits. So look at the exclusions. Look at the co-payment clause, if any, if and the pre-existing disease clause. The PSU insurers have a clause, pre-existing disease clause, for 4 years. Pre-existing disease will not be covered for 4 years from the date of purchase, from the date policy comes into effect actually. Other insurers will have about 2 years, I think, if I'm not wrong. So look into all these aspects, and if there is a history of illness, if there's one person in your family who's pretty ill, don't include them in the floater plan. Get them a separate cover, and the rest of the cover, rest of the guys can have a floater plan. So that kind of a thing. So it requires, please don't ask others what is the best plan, because it's an extremely private product. This is probably the most private product in the personal finance universe. Life insurance is quite simple. You die, you get money. That's as simple as that. Here, you can get sick in so many number of ways, and there are so many possibilities that other people cannot tell you what is good for you. Only you can judge depending upon your family circumstances, the city you live in, the money you can afford, the kind of what will happen tomorrow. You may need to go to another city and so on. So that can change things and so on. So depending on that, you may need to look at this product. It's not easy to buy this, I agree, but I suggest that you research it. Take about 2 weeks to buy, not more than that. Beyond that, it will probably never get done in time. Whatever policy you buy, I suggest that you keep enhancing the sum insured annually. A super top up is there, but I would prefer that I somehow am comfortable with just the base plan. Just increase the base plan, have a corporate cover, and Ashal keeps saying he says two things when it comes to medical insurance. One is, of course, use the corporate cover first, and two is, when it comes to claims, think like the insurer. If you are the insurer, what will you do? Will you pass the claim? Then your situation will become can be put in better context. So I suggest you think like that and buy this. Many people don't get this immediately, but I think they should research on this and get it done ASAP. So that's the third layer of protection. The fourth is accident insurance. This is something that many people neglect to buy. I would suggest that you buy as separate accident insurance. Anybody whose job is not permanent, professional businessmen, anybody, they should get themselves an accident insurance policy. Don't get an accident insurance policy, a group insurance policy from the bank. Don't get a policy which is as a rider to the term insurance. Get an independent cover from one of the PSUs, preferably. I think I trust them more than anybody else. That's just me. Uh, it's quite inexpensive and you can buy it, but please recognize it's a complex policy. It's not. Um, this is more complicated than even a mediclaim. In a mediclaim, you get hospitalized, you can claim at least some amount. Here, not all accidents will be covered. You have to be disabled. The accident insurance will come into effect only when you are not able to discharge your day-to-day duties, uh, either temporarily or permanently because of an accident. So it's not for all accidents. So beware of that. It's not a simple product, but I think you should. It's not most policies are identical. It's small differences. I have a post on this. You can look at that. Must know facts about buying accident insurance and so on. So um, get one. It's not so difficult. What about critical illness? Well, critical illness again is a very complex product. Um, if you have a history of critical illness in your family, your uncles, your aunts, they have some kind of your parents, obviously, if they have some kind of history of uh, heart disease, cancer, then I think the critical illness is important. Of course, if you get one under certain circumstances, it will become expensive, but there's no other choice. Um, Other people, I don't think it's essential. You can't look you can't get insurance for every damn thing that can happen to you in life. I mean, there are hundreds, millions of bad things that can happen to you, and you cannot get yourself insured for everything. That's not just possible. So you just have to cover against the basics and hope for the best. So I would suggest that if you don't have a history of critical illness, don't worry about this and work. Just invest as much as possible so that corpus will be used for medical expenses. So treat that as a long-term goal. So that's that. So I'm not included critical illness in this picture because of that. And the fifth kind of protection is just investing, inflation insurance. Much of what I'll talk about in the next parts will be about uh, protecting our long-term goals against inflation. So we will come to that later on. But I'll just say here that the number one enemy for efficient goal-based investing is interrupted compounding. That is, if we do not plan properly, if we get an emergency, suppose we stop our SIPs because of an emergency. Suppose the for any kind of emergency, maybe it is hospitalization, maybe it's accident, maybe it's some other kind of emergency. If we stop our SIPs or withdraw from our retirement corpus from the corpus meant for our child's education, that is, if we interrupt the growth of the corpus, then we cannot protect ourselves against inflation efficiently. So that is the main enemy for goal-based investing, other than of course our own behavioral patterns. So that's important to recognize. So it is to ensure that we minimize possibility of interrupting the compounding. We have emergency insurance, health insurance, accident insurance, and of course term life insurance as well. So it's because of that we have these other layers of protection. And the final one is called what I call as the action plan insurance. Well, the action plan insurance is a what to do plan. That is, let's say you are uh, the person in the house who handles all the money. Typically, it's the male. Maybe in some houses it's the female, and so on. Just one spouse handles the money. The other spouse is either not interested or has offers outside support, if I can call it that. So if you are the main person handling the finances, what will happen to your goals and your money management, your family's money management, if you get hospitalized for a few months, or if you just get too busy in your work and cannot attend to them, or if you just lose it and and just cannot function for some reason. So I mean, death is one thing. Of course, if you die, then obviously someone else will have to step in, but that's when a will uh, comes into picture. But there may be other possibilities where you are not able to do this job and you will still be alive, and so that's when an action plan insurance comes into picture. You write down an investment document, an investment policy document, or whatever they call it. Write down, discuss with your spouse, look, these are our goals, I'm investing here, here, here for those goals, this is my insurance policy, this is my medical claim policy, etc., etc., etc. Write down on a piece of paper. uh, Discuss it with your spouse or with your brother or whoever in your family who's responsible, as the situation may be, and hand them that piece of paper. That's the action plan insurance. In case you're not able to handle your finances, they will step in and do as per that plan. Now, in that plan, you can also indicate the name of a trustworthy person, like a fee only financial planner, or maybe someone like Ashal Jowri. Indicate their name and say, if you have any doubts and I am not able to help you resolve those doubts, contact this person. Write that down in the action plan, so that that adds an extra layer of protection. You may be in a coma for a few months, and who will handle money in between? So that kind of thing. Of course, the same thing can be extended into a will. In a will, you have explicit instructions about who gets what. It's about what to do with the money, what to do with your existing money. But uh, action plan insurance tells you how to handle long-term goals. For example, if you write a will and say, I have 10 crores and all of it will go to my wife, but then the wife will get 10 crores, and what will she do with it? If she doesn't know what to do with it, she will just buy the wrong product. She will just get an annuity for all the 10 crores and be happy with that constant pension and not worry about inflation later on. So she may buy wrong products if you do not tell them what they should do with the money. It's not just about who gets what, it's about what they will do with what. Of course, uh, you cannot, it's not a binding thing. You cannot tell people once you give them the money, they're adults, and you cannot tell them how they should spend it, but it's just a guideline about what should happen. So the action plan is, something that you can that has to be done when you're alive, and of course as well as in your absence. And so those are the basic layers of protection. And in the next part, I will talk about the second benchmark for money management, which is inflation. Catch you then. Bye bye.